In this part, we will focus what is common in investor perception across the emerging markets. And let's look at the market capitalization across all the emerging economies. And stock markets in emerging economies have been reaching new record level. This is because investors seek new markets with the prospects of enhanced returns in the current low yield environment of many developed markets. And for example, capitalization in China's stock market grew by 130% since 2012. With around 10 trillion United States dollars capitalization, it is the second largest in the world. Although it still remains far smaller than the United States financial markets, which is nearly 39 trillion United States dollars. But we must remember, investments in emerging markets involve additional risk that is not typical for developed markets. Let's look at what features of emerging markets an investor should consider before making important decisions. And the key risks which market participants face while investing in emerging markets are the following. First, the elevated volatility. Also, high risk resulted from sovereign inefficiency. There is also weak governance and low transparency. We also consider economic imbalances, trade sanctions and restrictions, these ones which may constrain economic growth of emerging markets. And lastly, weak market liquidity will prevent investors to get their fair value out of their assets in these markets. Let's start with the volatility. Corporates doing business in emerging markets often experience greater fluctuation in business operating conditions. And factors that can contribute to greater volatility include smaller and less mature market, larger GDP fluctuation, exposures to volatile demand, operational technological issues, weak currency, and also less predictability in the operation of their legal and regulatory systems. Even for small changes in the company environment may result in significant change in share price or interest rates. Thus, the fundamental analysis in emerging markets must rely more on qualitative rather than quantitative assessment. And additionally, investors must possess in-depth knowledge of the markets where the corporate operates. Let's now move to systemic risk exposures. It is critical to assess sovereign strengths, government policy, possible policy restrictions, and the legal and institutional environment. This is for a corporate and its investors, including their ability to expatriate their profits from emerging markets. For emerging markets corporates, the following considerations are often relevant. The first is the risk that sovereign experiences distress creates the risk that the corporation will be under distress as well due to macroeconomic and financial markets dislocation. And these factors usually accompanies a sovereign defaults. And the second is a weak sovereign institutional strength of the broad governance and political risk indicators. The third risk is the possibility of restriction on foreign currency exchange or profit expatriation. And the other factors, they include the depth of the domestic capital markets, the strength of the country banking system, and the quality of the company's accounting and corporate governance practices. Let's consider these factors together. First research question is to fully understand the impact that the sovereign profile can have on the investors domiciled of that market as a result of the spread of systemic risk. All companies in the same sovereign environment tend to be exposed to the transition of shocks within the given market, either across sectors or through the domestic banking system. And let's consider an example. The crises in emerging markets usually have macroeconomic causes. It may be disparities between supply and demand, cease of export markets, technological obsolescence, or fall in global commodity prices. The first results will be seen as a decline in income and consumption, lower tax revenues, high unemployment, and low ability of consumers and companies to repay loans. It also includes inability of borrowers to refinance loans and consequently higher loans defaults. Deterioration of macroeconomic conditions will result in weakening of banking sector. We will see the reduction in lending and difficulties to access to liquidity markets. This, in turn, leads to high dependence on government support. And severe economic conditions will result in contagion risk for other banks or depending sectors. The lower tax revenue with simultaneous need in increasing government support and also efforts to maintain the local currency can result in deterioration of government finance. It results in government spending cut, which means less investments and danger for the future economic growth. It also can result in higher costs of borrowing for the government. It creates contagion risk for other countries or segments. This will happen due to imposition of liquidity constraints, reduction in investors' confidence, unfavorable changes or restriction to movements in exchange rates, interest rates or price levels, and also increased risk of political uncertainty and civil and labor unrest. All these factors will negatively affect countries' macroeconomic condition. Thus, the negative spiral of the crisis is twisting and leading to the death of the companies in the particular emerging nation. All these issues are reflected in investor perception for certain companies. And for example, Moody's rated Turkish Koç Group only B2 with negative outlook. However, this is a diversified conglomerate, which including companies from various sectors you may see, such as energy, automotive, consumer durables, and finance. And if this company had been domiciled in the developed market, it would have investment grade level rating. The supporting factors actually include Koç's good financial profile, which is bolstered by a track record of financial discipline and adherence to internal financial targets at the parent companies, and its various investments. Historically, the company's cash coverage had been strong, with recurring income stemming from the investment returns, management fees, and interest income. However, the company has serious exposure to the Turkish economy, with all these risks which I mentioned. That's why it's valued by investors so low. And state institutions are an economy primary facilitator of social and economic development. They are actually a major source of the growth of the country. And effective institutions aid investments in physical and human capital and also technology. They have an important redistributive role to play in the economy and encourage trust in the economy. This is provided by policy and justice system which adhere to the common set of laws. And properly functioning institutions are a signal of the well-managed economy, enabling business to borrow money more cheaply. In turn, higher growth and lower borrowing costs give government the resources to spend on social needs, as well as on investments on infrastructure, health and education. Failed or ineffective institutions undermine trust, raise the cost of doing business, and increase the cost of government borrowing, thus, in turn, limiting the ability of the government to spend. It can quickly lead to the debt spiral from which recovery is very difficult. To gauge the quality of institution, investors usually use World Bank analytics, for example, World Bank governance indicators. And for example, Russia is known as an emerging market with weak institutions, especially in field of regulatory quality, control of corruption, or rule of laws, including enforcement proceedings. As a result, Russia, which possesses a vast number of resources, including intellectual resources, have been demonstrating quite modest economic growth. And this modest growth eventually translated in low asset prices in the stock market in the country, weak currency, and in unattractiveness to the global investors. And there is a significant contrast with the quality of institutional environment in developed world. See the most close neighbor of Russia, Finland. In this country, institutional environment is very strong, with majority of scores are close to 100, except maybe for political stability due to the recent change of the government. That is why the risk of investing in Finland is much lower. This is despite the fact that Finland has much less resources than its southern neighbor. In emerging markets, concern over a track record of sound corporate governance principles make it harder for investors to explicitly rely on financial policy commitments or other disclosures. Let's consider an example. For example, in August 2013, ENRC, a publicly listed Kazakh-based mining company, became the subject of United Kingdom Serious Fraud Office criminal investigation launched in April 2013. This investigation was relating to allegation of the fraud, bribery and corruption in Kazakhstan and the Democratic Republic of Congo. And this investigation followed with the resignation of the chairman of the company. And it happened only a few days after a founding shareholder of the company made public his plan to form a consortium with other founding shareholders to consider a bid to take the company private. And this consortium included Kazakh government. And the company value immediately fell down to £3 billion from £13 billion in 2008. As a result, the company had to delist from London Stock Exchange. And the weak corporate governance is also a problem for emerging market companies. Corporate governance concern is more prevalent among private companies with no track record of operating as public companies in the global capital markets and among family-controlled companies. And these are common structures across the emerging markets, as you may understand. And for example, in Indonesia, corporates remain largely family-controlled businesses that tend to have less transparent operation and disclosures. Although experienced and professional management may be employed by these companies, such structures raise several concerns about the safeguarding of investors' interests. They also raise concern if the founding families are able to exercise control to the detriment of other stakeholders. We will specifically consider the forensic issues of weak corporate governance in our next course, Forensic Accounting. Please stay with our program till its ends. The corporates in emerging markets which relies on local financial markets that in terms lack depth and more prone to stress tend to have weaker liquidity, and the access to foreign currency capital markets can be beneficial though for corporate liquidity by opening multiple financial sources. However, this access to foreign currency can also result in substantial volatility in the local currency value of liabilities due to the shift in the foreign exchange rate. A corporate exposure to volatile operating performance or currency movements can also be increased by other external vulnerabilities. And these vulnerabilities are linked in operation in markets with less developed capital markets, financial or banking system, or financial market practices. Sanctions or other trade restrictions imposed by developed countries have significant negative effect for both the sanctioned emerging economy and its participants and companies. And sanctioned companies usually perform poorly relative to other companies with similar characteristics. As a result, they have to cut staff and face a higher probability of going out of business. And from macroeconomic standpoint, sanctions which are aimed to reduce investments in foreign currency to the country usually results in financial crises. In addition, lack of investments dooms the country to lower level of economic growth and technological backwardness in the long term. An issue that is not often discussed in the public is that, at least for banks, no other sources for external financing except domestic has been found in this case. And for many international banks, the prospects of being blacklisted by the United States Treasury is simply too large a risk to take. To conclude, investment in emerging markets are associated with increased risk. Thus, the fundamental analysis of investments in this market must be expanded to assessment of a variety of other than financial factors. And these factors include macroeconomic profile of emerging nation, systemic risk and linkages, regulation and institutional issues, corporate governance, and susceptibility of event risk. In addition, analysis should include in-depth analysis of not only end markets which company serves, but also quality of infrastructure of markets which are the sources of funding for this corporate. And the analysis framework is presented on the screen. I strongly encourage the listeners to follow this framework in their course projects. And let's move on and apply the considered framework to compare two largest emerging economies in this group, China and India. Please stay with me.